Ladies and gentlemen, good day and welcome to Capital Small Finance Bank Limited Q4FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sarvajit Samra. Thank you and over to you, sir.
Thank you, Aviras. Good morning, everyone. Welcome to Capital Small Finance Bank Limited's earnings call for the financial year 24-25 and the quarter ended March 25. Thank you all for joining the call. You probably would have seen the financial results and the investor presentation that have been uploaded on the stock exchanges. Joining me today are Mr. Munish Jain, our Executive Director, Aseem Mahajan, CFO, Raghav Agarwal, Chief Risk Officer, Sahil Vijay, Head of Treasury and Investor Relations, Bharti Babuta from our Investor Relations team, and our IR advisors, SGA. The financial year 2025 unfolded amidst a backdrop of challenging macroeconomic conditions. While India's GDP remained one of the highest globally, it moderated to approximately 6.4% as per the latest estimates from the Reserve Bank of India. With the global context, we believe India is well placed. RBI has recently commenced cutting rates. The moderation in food inflation and headline inflation also augurs well. We have already seen 2 rate cuts and the change in stance from neutral to accommodative is a welcome relief for all of us. Reserve Bank of India intends to increase durable liquidity, which along with rate cuts will help supporting GDP growth of our country. Looking ahead to financial year 26, we expect India's GDP growth to be supported by a pickup in rural spending, a rebound in discretionary consumer demand, and a gradual revival in investment activity. The above-average monsoon rain forecast will boost agriculture output and economic growth. However, on the external front, goods export may continue to face headwinds until there is greater clarity on the global trade and tariff environment. Coming to the banks, April 2025, we marked a significant milestone, completing 9 years as a small finance bank and 25 years as a trusted financial institution. This journey would not have been possible without the unwavering support of our customers, employees, investors, and the regulators, to whom we extend our heartfelt gratitude. Turning to our performance, despite the economic headwinds during the financial year 25, Capital Small Finance Bank recorded a healthy 18% growth in profit after tax. We continue to maintain a strong capital adequacy position and ample liquidity buffers, reinforcing our financial stability. Our asset quality saw further improvement with gross and net NPAs declining. This progress is a direct result of our granular lending approach, strong underwriting standards, disciplined collections, and robust collateral coverage, which we have consistently kept our net credit losses well in check. Retail deposits remain resilient and continue to form the cornerstone of our liability strategy, reflecting the trust we have built over the time. With the environment remains challenging, but we are confident that our core strengths will help us emerge even stronger as an institution. We look forward to financial year 26. We are encouraged by the emerging policy tailwinds, including the prospect of interest rate cuts, improved system liquidity, and shift in the policy stance from neutral to accommodative. The outlook for credit continues to strengthen. With this positive and evolving macro drop, I now invite Mr. Munish Jain to walk you through Capital Small Finance Bank's performance for the quarter and the year. Thank you.
Thank you, Mr. Samra, and a warm welcome to all of you. Throughout financial year 25, we remain focused on deepening the customer trust, expanding reasonably, responsibly, and strengthening the foundation of a resilient, agile, and future-ready institution. With that, let me now take you through the financial highlights for the quarter and financial year ending March 2025. FY25 was marked by high interest rates, tighter monetary policy, and elevated asset quality concern in certain segments. Banking system credit growth dropped to 10.8% in FY25 from 16.3% in FY24. In this environment, bank witnessed healthy loan growth with improved asset quality. Our loan portfolio grown by 17% on year-on-year basis and 6% on quarter-on-quarter basis, and reaching to 7184 crores as on March 31, 2025, which is around 1.6 times of the system growth rate. Our growth continued to be led by secured segment, and 99.7% of our advance book being secured, and 79% of our portfolio is collateralized by immovable property / bank owned FDRs. The average ticket size of our portfolio stood at The average ticket size of our portfolio stands at rupees 15.9 lakhs, with 61% of the portfolio comprising clients with exposure of up to 25 lakhs. Our portfolio is well diversified across segments, each of which has successfully been navigated through multiple credit cycles. The composition includes 32% in agriculture against 32% in Q3 FY25 and 37% in Q4 FY24, 27% towards mortgage against 27% in Q3 FY25 and 26% in Q4 FY24, and 21% to MSME and trading loans against 21% in Q3 FY25 and 19% in Q4 FY24. The fresh loan disbursement for the year ended 31st March shown a growth of 38% on year-on-year basis and being stood at 2,846 crores. Further, disbursement for Q4 FY25 stood at 765 crores. The disbursement constitute 20% to MSME segment, 22% to mortgage segment, 20% to agriculture, 22% to NBFCs and the large corporates, and remaining to the consumption loans, including loan against own FDRs. The asset quality remained robust with gross NPA of 2.58% as of March 31, 2025, against 2.76% as of March 31, 2024, and 2.67% as of December 31, 2024, with negligible write-offs. Our net NPAs reduced to 1.3% as of March 31, 2025, against 1.4% as of March 31, 2024, and 1.35% as of December 31, 2025. Our slippage ratio for FY25 stood at 1.41% and for Q4 FY25 at 1.65%, against 1.45% in Q3, with upgrade and recovery ratio for FY25 stood at 1.12% and for Q4 FY25 at 1.38%, against 0.95 in Q3 FY25, calculated on annualized basis. Credit costs were contained at a lower, with 0.12% for FY25 and 0.13% for Q4 FY25, supported by robust collection efforts and minimal write-offs. Notably, there were no NPA sell-offs to ARCs during the period. SMA1 and SMA2, calculated as a percent of the advances, stood at 4.88% as on March 31, 2025, against 6.05% in December 31, 2024. Our total deposit base crossed 8,323 crores this year, growing by 11.3% year-on-year basis. Owing to lower CD ratio and higher liquidity ratios, bank continued with a calibrated deposit growth. The credit to deposit ratio on average basis increased to 81.4% in FY25 compared to 79.0% in FY24. Despite industry-wide pressure on CASA, due to the shift towards high-yielding term deposits. Bank's strong CASA share reflects its robust retail liability franchise. The bank continued to maintain high CASA of 36.9% as of March 31, 2025, against 38.3% as of March 31, 2024. Cost of funds for Q4FY25 and FY25 stood at 6% against a similar number in Q3FY25. Moving to the profitability metrics, pre-provision operating profit, PPOP, rose to rupees 48 crores in Q4FY25, registering a 23% growth compared to 39 crores in Q4FY24. For the full year FY25, PPOP stood at 185 crores, reflecting a 19% increase from 155 crores in FY24. The profit after tax for FY25 stood at 132 crores and for Q4 FY25 at 34 crores. That is 18% growth on year-on-year basis and 21% growth on quarterly basis. Our net interest margin improved to 4.2% in FY25, up from 3.9% in FY24, supported by improved CD ratio. Non-interest income as a percentage to average total assets improved to 0.9% for FY25 and 1% for Q4 FY25 against 0.8% for FY24 and 0.9% for Q4 FY24. The non-interest income primarily constitute core and stable fee income. Operating efficiency also strengthened, with the cost-to-income ratio declining slightly to 62.3% in FY25 from 62.5% in FY24, reflecting our continued focus on effective control. Our ROA has improved from 1.3% in FY24 to 1.4% in FY25, and the same was 1.4% in Q4 FY25 against 1.2% in Q4 FY24. The capital adequacy ratio is at 25.4% at the end of Q4 FY25, and our LCR on average for the quarter is 235.1%. During Q4 FY25, we opened 10 new branches, bringing our network to 195 branches across 5 states and 2 union territories, enhancing accessibility to rural and semi-urban markets. We have 77 branches in semi-urban and rural areas, and Shuru constituting 76% of our total deposit. Going forward, in FY26, we intend to expand our branch network by increasing the branch outreach by setting up 20 to 25 branches, by expanding outreach in contiguous states, coupled with deep penetration in existing market. We also intend to expand to 1 more states during FY26. Our endeavor is to organically grow our secured loan book, and we are targeting a growth rate of 20% plus by targeting MSME, trading, mortgage and agriculture segment. We will continue to expand in secured asset franchise with strong control on asset quality. We targeted ROTA expansion trajectory. Our focus on strengthening profitability metrics shall be driven by improving CD ratio, consequent NIM maintenance around the present level, optimizing operating costs and improving share of the fee income. We believe with our deep branch network, underwriting expertise, deeper understanding of our target segment, target niche, middle income group, Shuru segment, we have a strong growth runway as we expect. With this, I would request Mr. Samrat, I will request the operator to open the floor for any questions and answers session. Thank you so much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good morning, sir. Thank you for giving the opportunity. Sir, first question is about your FY26 as well as medium-term guidance on ROA and ROE. So the way I look at your performance, given the NIMs that we have, the yield that we charge at 11% and NIMs of 4%. So what is happening is, you are largely based out of Punjab. So as you want to show further growth, you will have to get out to other states as well. So I don't see your cost metrics going down, the cost to income. Given the 11% yield that we are doing, our credit cost is also very, very low. But there cannot be any improvement, of course, on that because our SMA is also 4-5% and it is already, credit cost is already very low. So how do we sort of increase this ROA and ROE going forward? Because even the deposit growth is amongst the lowest of all the SFBs at around 15%. So how do we, is there a path to increase this and then what will be the guidance for the same for both FY26 as well as, let's say, 3 years from now?
Service, if we talk about firstly, if I slice this question into the 3 parts. Firstly, as far as our business concentration, we have continued to expand our business out of Punjab. And if I talk about for the current year in the beginning of the year, we have 82.7% advances from Punjab, which has reduced to 78.8. So in turn, our out of Punjab credit market share as within our portfolio has increased from 17.3% to 21.2%. So we are continuously expanding out of our outreach out of Punjab so that we can have a fair presence in all the markets. Secondly, if we look into our ROTA and the way forward for the ROTA, we are presently having a average CD ratio for the current year being 81.4%. We intend to take it to our medium term basis to mid to the high 80s. And as far as the back of the envelope calculation, with every 1% increase in the CD ratio, with interest spread, that is the cost of deposit and the zero advances remain constant, there will be a benefit of around 4 basis points to the NIM. So our first driver for the expansion for the ROTA will be over CD ratio expansion, which is even as one for the FY25, it is 81.4% on average basis. That is the first driver available for the ROTA expansion, which will be available for over the next current year, as slightly for the current year and now more the medium term period also. The second driver available is over non-interest income. Our non-interest income presently for the FY25 is 0.9, which we have improved from 0.8 from the last year. We believe we will be continued the expansion trajectory in this with all the products being available. And I just like to flag over all of the non-interest income is of a stable fee income. So with all the products available, so that is another lever available to growth for the medium term strategy. That is from 0.9%, we looking forward for the expansion of the non-interest income. Yes, you pointed it right. The OPEX, given we are in the expanding phase, there will be limited choices available to significantly reduce the OPEX in a short term to very, very long short term basis. On a medium term basis, we will start getting some benefit from the OPEX reduction as a percentage to the average assets. So the drivers for the ROTA expansion, which we are doing in the current year also, which we have done in the last years also, and which we intend to do in the coming year also. One, by further improving the average CD ratio, which is 81.4% in current year, with the present LCR of 235 with the capital adequacy of 25% plus. With all these choices available, we look forward with a medium term basis a ROTA NIM expansion and non-interest income expansion from presently 0.9%. So these are the two drivers which is available for our ROTA and consequent for the ROE expansion in a short to medium term basis. And if I come to your next question about the deposit growth, as I shared as part of our presentation, since we have a lower CD ratio, so deposit and over deposit being 92.5% being a retail deposit with 36% being CASA, and we are paying a cost of deposit being 5.9 and cost of fund being 6. So we are following a calibrated growth on the deposit to take care of the need of the credit needs. So we are confident that we have a sufficient capability available to grow the deposit to support our business growth But our first endeavor is to firstly improving the CD ratio, which is 81.4% in the current year, and we improved it by 2.4% from 79% to 81.4%. So this is our perspective on this particular points.
Okay. So maybe, so let's say if we increase the CD ratio this year by 5%, then it will lead to around 20 basis point increase in your ROA. But beyond that, hello?
Yeah, please carry on.
So if we increase our CD ratio by 500 basis points, you can increase your ROA by maybe 20 basis points, and then we can also have maybe 10 basis point improvement because of the non-interest income. So around 30 basis point increase in ROA we can get maybe in 1 year or 2 years. That is well understood. But beyond that, sir, since our deposit growth it is low compared to most of our peers, and B, I can also see in your presentation that it has come down significantly from pre-COVID to post-COVID. So what is the strategy? Can it be a more? 13% deposit growth is even large PSU banks at a very large scale are doing that sort of a deposit growth. So at your very small scale and presence in just one state, more largely, how are we thinking about 13%, sir? What are our plans around that?
Service, as I reiterate, as far as the ROTA expenses you said about the two numbers, I like say just these are the numbers which we can consider for a medium-term basis. I don't want to give any timeline to this particular number, but these are the numbers which is a mathematically very well feasibility is there. And as far as our deposit franchise is concerned, if you look into our deposit book, you will see our deposit is purely retail. Without current year, we have not increased the bulk deposit. Beginning of the year, our bulk deposit was 7.5. At the end of the year, it is 7.5. We get whole of the growth from the retail deposit only, and with the very, very distributed retail deposit, which is around 11% growth. And we have calibrated this growth. Given we want to improve the CD ratio and given the scenario on the asset side, so we consciously and responsibly grow our advance book to keep an eye on the asset quality. So we believe a better growth rate in the deposit in the current year, and as I said, we intend to grow our loan book by more than 20% in the current year, keeping in view the present environment. Some positive change in the environment may have a positive implication, but presently, as we look into the present environmental, so we're targeting 20% plus growth rate on advances, and we believe we will be growing our deposit at a faster rate than we did in the last year. But saying all said, we intend to grow over CD ratio from 81.4% to some further higher levels.
Understood, sir. And the last question is, your credit cost is only 10 basis points, which is much lower, very low than many other banks. But your SMA is quite high. 5-6% is much higher than many other peers. So what is the reason behind it, and how do you see the credit cost? What should be the normal credit cost that we should pencil in for your business?
So if we look into the credit cost on the average assets or the credit cost on the average advances, our credit cost, which you have been saying as a part of the ROTA tree, is typically credit cost to the average assets, which is 0.12 for the current year. If you calculate it on the average advances, it will turn out to be 0.18 to 0.2%. If I talk about our historically average credit cost on the average asset basis, we always remain in the tight range of 0.1% to 0.15%. Except 2 years, which is a COVID hit year, in which this particular number has been a bit higher, and that too not on a loss basis, but on a required provisioning basis. We believe going ahead also, we want to keep it in a tight range of 0.1% to 0.2% for the current year also, and going forward for a couple of years. So we are quite confident to keeping it in a tight range of 0.1 to 0.2% as we move forward. And as far as the estimates are concerned, so the SMA is typically below 5% presently. I respect your views, but sir, we believe in a retail franchise when with the average ticket size of 50 lakhs. So having a SMA which is below 5 is with a huge efforts. Yes, we aspire to achieve more, but we are quite happy rather with the present SMA number of 1 and 2 put together being below 5% of the total portfolio. And most important thing, sir, I like to flag here, we have not written off any assets. Significant written off, it will be written off is less than 1 crore rupees, and no sell-off of the bad assets to any ERCs. It is purely full recovery effort-based credit portfolio.
Understood, sir. Thank you and all the best.
Yeah, thank you, Service.
Thank you. The next question is from the line of Shreyash Pimple from JM Financial. Please go ahead.
Hello. Can you hear me? Hello.
Yeah, Shreyash, you are audible.
Yeah, thank you so much, sir, for the opportunity. I wanted to understand the impact of rate cuts on NIMs. You highlighted in your opening comments that your NIM, you want to keep it at a stable level of around 4%. Can you highlight, on the asset side, what is how much portion of the book is floating rate? How much is the fixed rate?
Surely. If we look into our total portfolio, as on March 31, 2025, we have a 55% book which is a floating rate book. The same number was around 61% a year back. So during the period we were seeing an interest rate downward trend, so we increased the fixed rate book for our portfolio, and presently our floating rate book is 54.77% as on 31st of March. Within this, we have 12% of the book, which is a EBR linked book. So we have around 12% book, which is a EBR linked based book, which has a direct implication of this EBR change. And the remaining book is a MCR linked, which will be dependent upon our cost of funds. So that is one aspect I like to flag. So to counter this particular 12% book, which will be impacted directly by the interest rate cuts, so we have already factored in, the ALCO has already decided that we have reduced our saving bank rate also by 15 basic points, so that we can continue to retain the NIM, which is at the retain and improve the NIM from the present level. And presently we are having a NIM of 4.2%. It is not 4%, it is 4.2% presently. So we intend to maintain and improve the NIM from the present level for the current fiscal, despite the fact we are anticipating some further rate cuts. And the rate cuts impact on the EBR link is immediate basis, whereas on the deposit it will be with a maturity or a rollover basis. But just to share you with the balance sheet construct, if you look into the balance sheet construct, we are typically having 45% of the advances on a fixed rate, or rather I will say 55% of the advances, or 54.77% on a floating rate. And similarly on the liability side, we are typically having 36 to 38% CASA, and 62% of our deposits are term deposits, which is linked with the interest rate. And out of this, presently we are having more than 85% of the deposits with the contractual maturity of around 1 year. So that also will be get repriced whenever the repricing based MCLR will be happening, so that we can manage both upward and downward interest rate scenario in a more efficient manner. So that's the reason we are confident of maintaining and slightly improving the NIM even for the current fiscal.
Sure, sir. I mean, that is very helpful and that gives the confidence. Second question was on the growth of the bank, sir. You said that you want to expand out of Punjab. Also, in the other loans, in terms of the yields, as in, I wanted to understand, will you be willing to increase the portion of higher yielding loans in the current book, to expand your ROAs going ahead, whether it is in the current geography of Punjab or when you expand out of the geography?
If I talk, Shreyash, about the overall perspective, we intend to remain in middle income group based lender. We intend to maintain a secure lending franchise, we believe there is enough opportunity of growth available for a secured lenders in a middle income group for the production credit. That is the three segment which we are specializing in. That is the mortgage, MSME and trading, and agri. So we will continue to grow in these three segments as we move forward. Depending upon the state in which we are expanding, our paddle will keep on moving. What I mean by this, say we are now currently we will be expanding in Rajasthan, and Rajasthan we will be targeting the mortgage market. So we will be putting over higher MSs in Rajasthan for the mortgage market. And if now we will be expanding more in Delhi. In Delhi, we will be putting a more target on MSME segment. Since we are not a monoline business product, we have a multi-lending products within the middle income group segment. So depending upon the geography and the potentiality available, so our paddle, our product under consideration will be keep on moving. So since we have all the three products available which is needed by the middle income segment. So going ahead, we intend to remain these three bank product lender, and we intend to expand our NIM. Yes, we are not intending to enter into unsecured piece with the, we want to grow responsibly. We want to grow responsibly. Saying all this, we are growth hungry, and we intend to grow at much faster rates. Yes, and we, as I said, if with the present market environment also, we are confident of growing more than 20%, and I believe the market environment from the more clarity on the tariff, world trade will improve and help us improving our growth trajectories. So this is what I believe, and with this we want to improve our margins both in terms of NIM as well as the ROTA as we move forward.
Understood, sir. That is very helpful. Just the last question. You said that on the other income part, you will be increasing the other income gradually. Can you explain as to exactly what part of other income you will be focusing on? Will it be banca commissions? Will it be operations related to fee income? So what portion are you focusing on?
As we look into the present other income spec, which is available on slide number 10, we are having a very, very mixed other income, which is from all the segments. Current year, we want to expand both advance-related fee income, operation-related fee income, and banker-related fee income, which may be supported further by some treasury benefits. Because in the last year, we made only a peanuts. In the last 2 years, we made only a very, very smaller money from the treasuries. So the current year, I believe, with the type of the interest rate environment, which may have a difficult from the NIM side, but will be giving us a benefit from the treasury income side. So it will be compensating that particular small growth impact on the NIM, on the expansion of the NIM, will be compensated slightly by the treasury income also. But saying all this, I believe current year, we want to intend our customer outreach. We were doing NTBs, I will say new to bank. From last year, we have started moving to the deepening price. That is selling, deepening the present customer base. So with the deepening drive already being started, I believe going forward also, we intend to grow all the three pieces. May it be advance related fee income, may it be operations, that is a payment channels related fee income, or may it be banker commission fee related income, that is selling other financial products. So all the three products are in our target segment, and we intend to grow all the three as we move forward.
Sure, sir. That is very helpful. Sir, on the last part on the LCR, the new regulation on LCR, do you see any impact of that regulation on the bank? I know the LCR ratio is very high for us, around 235%. But is there any negative adverse impact?
As far as our presently calculation, LCR, I'm very surprised to see RBI also said there will be positive impact visible on the banking around 6%. And as per our model, as per our position, as on 31st of March 2025, with the new LCR guidelines, we will be having a positive effect of 6% on the present LCR.
Thank you so much, sir. That was really helpful, and all congratulations on the quarter, and all the best for the near future, sir. Thank you.
Thank you, Shesh.
Thank you. The next question is from the line of Shripal Doshi from Equirus Securities. Please go ahead.
Hi, sir. Good morning, and thank you for giving me the opportunity. So my question was on growth side and also on deposit side. So since you highlighted that we are trying to calibrate our deposit growth in such a way that our asset growth also leads to better asset growth and also our margins remain healthy. So, do you think that we should rejig our deposit strategy, because there also the growth is soft at, let's say, closer to 14% for the year. And even on the asset side, if you look at in the last 3 years, our growth has not been more than 20% in any of the last 3 years. So, maybe a time to look at this strategy little differently on deposit side and therefore benefiting the asset side as well. Just your comments and thoughts on this.
Shripal, as I said, we intend to grow faster. Last year also there was, because of certain actions, and that is a certain stress coming in certain segments and certain macro level factors, there has been a sluggishness in some of the growth in the industry as a whole. As I said, industry as a whole, growth has subdued from 16.4% to 10.3% for the industry as a whole. So we, being part of the industry, we grow 1.6 times of the industry. Yes, we believe we had a more potential and we had a more capacity to grow. And but last year we grow responsibly. So that's what we are saying. And current year we are now fully geared up. All the things are in place. Out of Punjab book is start growing with a much faster way. The Punjab has start contributing good. Asset quality is in control. Liquidity is available. Capital is available. Market dynamics, especially on MSME, start looking good. So with all this thing in sight, so I believe the growth rate in the current year seems to be more than 20%. We are quite confident and we are giving a guidance accordingly for that. On deposit growth perspective, we intend to grow. We intend to grow over deposit growth rate from the current year at a faster rate. So this is already in the plan, and our budgeting are also towards that direction. That in addition to the advanced linked growth, last year we were working on improving the per branch disbursement matrix KPI. And if you look, over disbursement has improved by 38% on year-on-year basis. So we have touched almost 12 crore rupees per branch disbursement through the branch channel, average disbursement per year. So current year we are targeting increasing the deposit per branch contribution. So that is the KPI we have internally taken. So I believe, we are also internally on the same track to support the advanced growth and also having a better deposit growth as we move forward. So you will see a better deposit growth in the current fiscal as we move forward.
And so on the asset side, what sort of a mix that will emerge? Because if you look at this year, agri has shrunk to almost 33%. So will it further continue to sort of contract? Because as we move into non-Punjab geographies where the credit pickup for MSME and mortgage is relatively higher, so will that mix change happen in FY26-27?
I believe the over change in the current year mix was because that we have grown faster in MSME. Current year we intend to grow faster in MSME and trading book, which is presently 21%. We intend to improve this number. So you will see some increase in the ATS also in this portfolio, so that we are targeting a little bit higher segment but remain within our portfolio. So you will see some ATS also increase in the coming year in the MSME and trading book. So that particular portfolio shall grow, and we also intend to grow mortgage. But we are not intending to shrink further the agriculture. Agriculture will be hovering around the similar levels for the current year, and just we want to improve the MSME, maybe taking out from the other loans.
Got it. So one last question was on the kind of margins that we see to happen in FY26, and just comments on ROA for FY26.
We at this point, we closed the last fiscal FY25 at 1.4 ROA, and we are continuously improving our ROA from last many years, 4-5 years consecutively. FY26, we also intend to further improve the ROA. At this stage, I don't intend to give any number to this, given the market dynamics on the interest rate environment is too uncertain. But given all this, we are giving a guidance of improvement in ROTA. So how much improvement in ROTA will be depending upon the market forces. But we are confident of improving the ROTA again in FY26. So that is what I want to say. Whatever we earned in FY25, we intend to improve the ROTA further in FY26.
Got it, sir. Got it. Thank you, sir. Thank you so much for answering.
Yeah, thank you, Shreepal. Thank you, Shreepal.
Thank you. The next question is from the line of Anant Mundra from My Temple Capital. Please go ahead.
Hello. Thank you for the opportunity, sir. Sir, so we've had a slightly slower growth in agri this year. So is it because, we are well penetrated in Punjab and the opportunities to further mine are fewer, and that's why agri has been slow, or is there any other reason attributable for this?
Hi, Anand. The basic factor, as I said, there is no contraction in agriculture book. Agriculture book on a standalone basis has improved. On a percentage basis, it has contracted. So the reason for this contraction on a percentage basis is a better growth in the other loan segments. Yes, we were doing agri primarily in Punjab and some portion in Haryana. We are not doing agri in other part of the country, that is other states. We are doing agri primarily in Punjab and some portion of Haryana. But we are seeing some opportunity coming up in the current year again now in the agri. So as I said earlier, agri portfolio, we are not looking forward for any further contraction. We will believe that we will be retaining at the present level. So there was a contraction there was a contraction coming for the reason of the other segment need to be grow at a faster rate. Now I believe agriculture will be matching up with the overall growth rates, maybe, and retaining its share, which is around 32% in the range of 31 to 32% or 30 to 32% is what we intend, or 31 to 33 is the type of the range we believe agriculture will remain. So it's just, we were a bit caution on agriculture in the last year, and now with all the things in place, now everything is settled. I believe agriculture we are confident on agriculture growth as well as we move forward. But by saying all this, since our out of Punjab book will be dominated by MSME and mortgage, and our out of Punjab book, as I said earlier, has improved in the current year from 17.3% of the total portfolio to 21.2%. I believe we will be continue to see a further improvement in this matrix and consequently growth higher percentile toward MSME oblique mortgage. Anand, am we audible? Anand? Avirat?
Yes, sir. Anand isn't audible. I'll take up the next question.
Okay. Please.
Which is from the line of Rishikesh from Robo Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. Am I audible?
Yeah, you are fully audible, Rishikesh.
Yeah, thank you. So, sir, net NPA, which is currently around 1.3%, and we had earlier targeted that we will bring net NPA below 1 as a criteria for universal banking license. So, given that our normal credit cost around 0.1, 0.2%, will we need any additional credit cost for this year?
Yes, as a principal guidance, we intend, our target line was to bring it to around 1%, to the 1% level in the current fiscal, that is FY26, to be eligible for the universal banking license. So we believe in the current year we are able to improve it by 10 basic points without any additional credit cost. So I see we will be able to contain it by a big percentile by on a natural recovery effort based, which is a recovery effort based. Since our slippage ratio, we are able to contract the slippage ratio for FY25. The slippage ratio for FY25, which is 1.41%, and it was 2.4 in FY24. So we are able to contain our slippage ratio by 100 basic points, which was 2.4 in FY24 to 1.41 in FY25. So this contraction in the slippage ratio for that year, so the recovery is typically taking this lag. So I believe we will be having some natural tailwind benefits of our net NPAs. And basis this, we intend to make it below 1% of that level, and for any additional provision requirement, if any needed, will be evaluated at that point of time in the broader spectrum and as looked by my apex body over my board of directors. So that is what we believe, but we are on that direction, and accordingly, the slippage as well as the net NPA has reduced, And with the reduction in slippage ratio in the last financial year, I can sense it better our net NPAs in the current year as a natural consequence.
Okay, got it. Thank you.
The next question is from the line of Anand Mundra from My Temple Capital. Please go ahead.
Hello, am I audible?
Yeah, Anand, I think we lost the line. So I trust you heard what I said, or you missed something, or I should repeat it?
No, sir, I heard you. So that's okay. That part is done. Sir, I wanted to check on what our deposit share is out of Punjab. Could you give some color on that?
I can try to share on this thing rather than from Punjab versus out of Punjab. I will just share you one data which will be of data of interest for you. We are having 36.4% deposits from a rural area. We have 39.5% of the deposit from a semi-urban area, and we have only 24.1% deposit from the urban area. So our deposit franchise is granular. With the average ticket size of the saving bank account has increased by 1,000 rupees during the current year, which was around 41,000 has increased to 42,000. We improved the average ticket size of current accounts also, which was around 1,24,000, which was around 1,27,000 last year, has improved to 1,40,000. So as an intent, our intent is to continue to be granular and a deeper deposit franchise. So saying all this, so Punjab and Haryana presently and going forward will be going to be over a larger deposit market. So that is what I trying to intend to say. Yes, on advanced side, we have started moving out of Punjab, but Punjab is going to be dominating for our deposit market. And it has been presently 91.95% against 93.89 a year back.
Got it. So, sir, when we mentioned that Haryana is going to be the next Punjab for us, so I'm guessing our deposit, because we're very strong in deposit franchise in Punjab. So, what is the comfort that we are getting that our deposit franchise will be as strong in Haryana as well when we grow there?
That is comfort we are getting is that 2 or 3 sides of comfort. First comfort is the deposit mix we are getting from Haryana, that is from the share of the CASA. Second is the growth coming from Haryana. If we talk about we have declined 2% from Punjab, that whole of the majority of that is coming only from Haryana. And Haryana is started contributing from all the metrics from that particular side. So we are confident as we move forward. Haryana is presently constituting having only 20 branches out of total 195 branches presently. And current year we intend to add 10 more branches in Haryana to make it over 30 branches, which make us eligible for the government business also in Haryana by end of this year. So which will be helping us further in gathering a better retail deposit. With that, we will be able to have a better customer connects. So that's the way we call making Haryana our next Punjab.
Got it. So you mentioned CASA is quite good there. So what is the CASA in Haryana?
It is almost at the bank level. So we have bank level around 36%. Haryana will be also around the similar or a slightly higher level.
Okay. And so you mentioned you're opening 10 branches in Haryana. So and what is the overall target that we have for the entire bank?
We intend to open 20 to 25 branches or say around 25 branches.
Okay. And so Haryana is 10. And how much would be within Punjab out of this 20-25 branches?
So instead of giving any number for the state specific, so Haryana we intend to make it 30. That is our start point. So that is the reason so that we are eligible for certain additional benefits from Haryana. So we are targeting 10 for Haryana. The other branches will be mix of the Punjab, deep penetrating in Punjab, entering into other states, and we also intend to enter one more state during the current year.
Okay. Got it. And sir, so if I look at the SMA1 and SMA2 book, you mentioned that it is below 5%. But if I see the trajectory, I think last to last year it was about 3.5, 3.6%, and it is going up. So doesn't that worry us, because our credit cost is quite low, and any shoot up that is happening in SMA will further lead to gross NPA flows and could further increase our credit cost, which is quite low.
Anand, if you look into our SMA number FY25 was 4.46 and presently is 4.88. So I see it is a few basic points up and down. So I will not term it as an increase. Since even if you look into this increase, this is not an increase which we can say on a face. That is not even a 1% change. That is not even a 0.5% change. So that is a slight change. So we give it a number. So there is no alarm signal or worrying signal coming out of this. At least what we see out of it. So it is all, I read it as a similar number. So some percentage, some basic point change is not a thing to be worried about. And this is what we internally believe.
No, I was actually comparing from FY23 number where it was about 3.5, 3.6. So probably that could have been an exception. I don't know, but from there it appears quite high.
Those were the years when there was COVID-related repayments, restrictions were also there for a longer period. So restructuring provisions were there. So those were those years when there were a lot of other additional benefits which may be coming out, pouring out from the last period. So last year was one of the years in which there's a full-fledged proper year, no benefits or repayments. Currently is a second such year, second time, 2.5 such years. So comparison metrics, if we look into FY24 versus FY25, we are almost at a similar level. I will say it's a similar level. Because the delta between two is not even a 50 basic points.
Okay, got it, sir. And so one final question was that you guided that, our NIM typically expands by 4 pips if the CD ratio expands by 100 pips. So for this calculation, what kind of rate cut have you already factored in?
For this particular calculation, the calculation is based on a simple math. That is the interest spread. That is the difference between cost of deposit and interest on cost of deposit and yield on advances remain constant. Any change in that particular spread will have a different implication. So this particular thing is just pure plain vanilla. What will be the benefit of NIM of the CD ratio expansion? The other factor change. That is a change given some contraction in the industry level changes. If any happen future, that is a separately. So that is an additional bonus or additional benefit which is available in the balance sheet other than the other interest related aspects. So that is what I'm trying to clarify. So that is an additional benefit which is available. Other benefits and oblique challenges which is available for all other people like us will remain constant.
Okay. Oh, got it. And sir, would it be possible for you to give the PCR breakup across segments, agri, mortgage, MSME and trading and the other segments?
At this stage, I'm not handy. I will ask my IR team, Bharti. She will connect that to you and share this number.
Okay. Thank you, sir. That's it from me.
Thank you, Anand.
Thank you. The next question is from the line of Sanjay Shah from Pranishta. Please go ahead.
Hi, can you hear me?
Yeah, Sanjay, fully audible. Good afternoon.
Thank you. Congratulations on a very consistent set of numbers as you've been reporting over the last several quarters. Just a question, not in the now and the near, but over the medium term. It could be 3 years, 4 years. But where do you think you can take your ROTA up to return on total assets? Effectively, how much can you compound your book over a 3 to 4 year period and ROTA?
Sanjay, you, I think, asking me about my bucket list. So I am on an earning call and talking about my bucket list may not be advisable by my peers. But I think you are asking purely my bucket list and what I wish and what I believe our model we can take it. Instead of quoting any number, if I give you the guidances or the way forward or the things, if you look into our present ROTA tree, you will see we being 4.2% NIM with the 81.4% CD ratio. If we look into with the interest spread, that is a difference between cost of deposit and yield on advances being 5.2 to 5.5. With that, we are typically having 4.2 NIM. If I believe that 4 basic point increase is happening over a medium term basis or over a year, if this 5.2 to 5.5 remain in the same range with a 100 basic point change, and we intend to take the CD ratio to mid to high 80s. I never said we want to cross 90. we want to make it mid to high 80s, so we have a legroom available for 7 to 8 basis point increase. So which will be giving us some benefit, and it is not a year scale, it is a couple of years which will be required. So that is the one ROTA expansion tree available. Second tree available is about the non-interest income, which presently is 0.9, which we are continuously improving, which was 0.6 in FY23, which was 0.8 in FY24, which is 0.9 in FY25. If I talk and with the deepening drive with the customer profile touching almost 8 lakhs, 7.85 lakhs to be precise, with our deepening drive with all products being in place, I believe this number has a very high opportunity to move it further. If you look into the various other universal commercial banks, you will find this number to be in the range of 1.25% to 1.35%. And if we iron out the trade finance, since we are not in a trade finance, this number will be 1.1% to 1.25%. So we have a sufficient option available, we have a sufficient opportunity available to expand it. And third, that is the OPEX. OPEX which we believe will remain constant for current year or maybe for one more year, and which is around 3.1% to 3.2%, which is the range we are maintaining for some period now. I believe maybe for a shorter period it will remain in this tight delta. But ultimately, with the model which we are talking, with the matured branches mixing moving up, and when we will be drying up the NIM expansion and the OPEX expansion of earning expansion, this particular driver will come into the play. From 3.05, 3.1 to 3.2, the decline has to be there. And if you look into the industry average, the guy who will be crossing the similar type of model with a retail franchise, you will know what sort of the cost income ratios these guys are playing and what sort of OPEX ratio to the average assets they are playing. So I believe this is the third play which is available. So with these three available, with a 1.4% ROTA being presently, I believe the opportunity or my bucket list to see it growing is phenomenally high. But we need to, I just want to be very honest upfront, that we are a growth hungry and we don't want to be a stable state entity. We want to be a blended entity for a period, for some while as we move forward. But in a blended while also, we are able to improve the ROTA and we are maintaining this trajectory that we intend to improve the ROTA which is passing here. Despite the fact we are a blend entity and with a growth higher branch being opening. So I believe the expansion in the ROTA over a medium to the long-term basis, the levers are phenomenally high. My apologies, I'm not will be in a position to share the number since I'm constrained to share the right numbers, please.
No, that's right. I guess one of the reasons why everybody's asking about the deposit growth is because we can completely and fully understand the fact that you have sufficient lever to improve upon the credit deposit ratio for probably a year and a half. And as you rightly said, you don't want to go beyond the 90s. So I guess indirectly, directly, we're all wondering what the longer term trajectory can be, but we completely understand and respect what your response is. So thank you very much.
Thank you, Sanjay.
Thank you. The next question is from the line of Iqbal Singh from IFM. Please go ahead.
So my question is, what is your preparedness for the universal bank license and when we can expect that?
Iqbal, I just want to say it in this way. I, as a representative of my board, I can say our target is to tick the boxes to be eligible for the universal commercial bank. At this point of time, with the scale we are having, I believe my apex ready, my board will be deciding the factors when to apply for the universal bank. But one thing is we are quite ambitious and we are quite the universal bank transition is the one path which is quite encouraging for me and my whole of the team, which will keeping us quite motivated. Saying all this, I just like to flag 1-2 points, Iqbal. If you look into the business model on which Capital Small Finance Bank is earning, the arbitrage between SFB and UCB from the earning and the growth perspective. The three arbitrage, one being up to 50 lakhs, there has to be 50% up to 25 lakhs, there has to be 50% portfolio. We are way ahead of it, we are 61% plus. 75% need to be PSL, our model is PSL driven. Third, higher capital adequacy, we are already having a 25% capital adequacy. So even in the transit period or in the interim period, so our board decides when to apply for the UCB. Our growth rate and our asset return metrics will continue the similar trajectory. Just converting into universal bank will help us in further expansion of the ROTA by having a better access to the retail lower cost deposit. So with that thing in sight, we intend to tick all boxes in the current fiscal as we guided in the last calls. And the next call will be taken by our tax body, my board, after evaluating all the situation existing.
So when you are expecting that your slippage, which you have done a very good job in FY24, which was 2.4%, and as in FY25 it is 1.41, and when you can expect, because this is one of the hurdles that you have to be less than 1% slippage. So when do you expect in FY26 you are able to do that? To have the slippage less than 1%?
Iqbal, just clarification. 1% is not the slippage ratio which is required. 1% is a net NPA ratio which is required, which we are presently at 1.
Sorry. Net NPA. Sorry. Net NPA.
Which we have already 1.3. I believe we are intending with our growth, with our recovery efforts, our internal target in the current fiscal to tick that box. Yes, it is linked with a lot of macro factors. Iqbal, lenders are with the macro factors. Just with the present macro factors being remain constant or some improvement, I believe we are internally targeting to tick the boxes as we discussed earlier in the earlier calls. We intend to tick all boxes in the current year, FY26.
Okay. One more additional question. How much spend is there on a digital transformation or digital onboarding of any metrics of revenue or income?
As far as if I talk about Iqbal, we typically have a decent spend on the IT-based spend, whether be a security related or the infra related or the other peripheries. Just a proxy to this, we have 88% of the transactions are done presently through a digital mode, which was around below 50% 5 year back. So even if I talk about FY22, post the COVID has started, this number was used to be 70-71. We currently come 88% of our present transactions are purely in a digital platform. So we are constantly spending and constantly evolving on a digital front. But I just like to very upfrontly flag Iqbal. We are a fizzy digital entities. We are a semi-urban and rural area specialist and a middle income group specialist entity. So there are a lot of such play where require a human connect. We are available digitally for all the transaction and 88% of the transaction is a testimony to that. But we are proudly saying we are a fizzy digital entity where both the digital and the physical faces will be available to our present and prospective clients. And since a lot of Suru India is started transacting on a UPI, but for the lending practice or for the deposit practice, they're still expecting a physical face. So we are available both physically and digitally in all the channels. And that's what our philosophy and our outreach program is.
Thank you, sir. And once again, congratulations for presenting wonderful numbers.
Thank you.
The expectations of the market. Yeah.
Thank you.
Thank you. The next question is from the line of Pritesh Baum from DAM Capital Advisors. Please go ahead.
Hi, sir. Good afternoon. A couple of questions.
Pritesh.
Sir, have you done any rate cuts already after the repo rate cuts? If yes, how much and which products?
I missed a question, Iqbal. Okay. Iqbal, Pritesh. We have done rate cuts. We have done a rate cut in our saving bank deposit rate by 15 basic points, which will be effective from 1st of May, and it has been cut, already been cut. We have cut over bulk deposit, term deposit rate on a non-callable bulk deposit rate, which has already been effected. So these two cuts we have already implemented, done over the month after the present last rate cut on the current month only to help us retaining the present names.
Sir, the SAR deposit cut, now what do we give to our customers? I believe it was 4%.
I missed what you said.
No, it was 3.5%. Now we'll be offering 3.35 from the savings bank from 1st of May. It was 3.5%.
Right. And so on the asset side, have you done any rate cuts? Any pass on has happened already?
As I said, we have presently 54.77% floating book, out of this 12% being a EBR linked. We have done the pass out on the EBR will be all done automatically in the beginning of the month in which the EBR cut. So last EBR cut has already been passed and the current April month EBR cut will be effective from 1st of May. So that is for the 11.74, or I can say around 12% of my total portfolio, which will be moving on this particular EBR rate with the benefit. On MCLR, it is constant. We have not reduced the MCL on the current month, and I am not sensing MCLR, so that is what we are. On the other 88% of the book, or 88.25% of the book, there is no interest rate change which we have factored in.
Got it. Sir, so you mentioned that you may look to move to a new state, but wanted to also check if you are introducing any new product or starting any new product in the bank.
This is, we typically intend with a simple philosophy that we want to be the primary banker of the customer and for our middle and group segment customer. To achieve that, we keep on evolving on our product. So since on the lending piece, we believe we have almost all the products, just fine-tuning of the products keep on happening. We recently launched a business lab product in the last quarter. So similarly, fine-tuning of the product, which we are doing and we will continue to do, depending upon the new geography where we are going, new customer segment which is coming, and new opportunity we sense to address and to ensure that customer set is coming. So with the overall guiding force, we want to be lending to a middle income group segment, secure lender, and for a production credit. That is who is doing the businesses, agriculture, or taking care of his housing needs. To achieve this particular thing, any evaluation is what is required. We continue to do it, and it is a natural, regular practice which we will keep on doing, and we are doing it, and we will continue to do it.
Sure. And last question is that you mentioned about the mix going ahead, especially in FY26, which means that the corporate mix will be down in FY26, right? Basically, it will grow less than 20%, then only the mix will come down and other mix will move up.
But Pritesh, I say maybe it may not be only the corporate. Corporate is presently, we have a total 20% loans in consumption and the corporate book together. I believe going forward, we intend to grow MSME, and this 1% or 2% growth in MSME may be coming out from other loans or maybe some other segment. So I'm not saying that it will be necessarily because we are not, we have put it at internal limits that we don't want to go with more than 15% in the large corporates. So we are well below that limit. So we have our internal thresholds for each of the products, especially for this type of products. We are presently very mindful of what we are lending, and we are lending very responsibly. And we will continue to lend in a responsible environment, giving a very, very micro level cut of my FY26. I'm saying is not feasible. Just our endeavor is to increase our MSME and trading book and mortgage book as we move forward. And we're seeing an opportunity also in that. So it may be coming from my corporate, it may be coming from my consumption, or it may be coming out slightly from my agriculture.
Okay, sure. Thank you so much. All the best.
Thank you, Pritesh. Thank you.
Thank you. The next question is from the line of Rudransh Kalra from MB Investments. Please go ahead.
Hello.
Yeah, hi Rudransh.
Hi. My question is, what would be your loan mix in terms of like gold loans, housing or LAP, vehicle loans, and so on and so forth? You could explain that'd be easy.
Surely. If we talk about firstly the LAP business, which is we typically call a loan against property. Loan against property will sit under the mortgage book. Presently we are having 27% mortgage book. It will be having around 12 to 13% LAP business, which will be primarily to the MSME clients. So this will be typically, we can call it a business LAP, we can call it a MSME based clients in LAP business, which will be around 12 to 30.5% in the business. If I talk about the gold loan, auto loan, personal loan business, which is typically, we are talking about that particular business, will be around 3 to 5% of the total portfolio. So these two things put together will be around 7.5% to 18.5%. That is the delta we typically maintain, 7.5% to 20%. So in this particular type range, you will find all these type of lending which you are mentioning. But I want to mention we differentiate LAP, because LAP also include the money which we give to the MSME against the property and which is used by him for his businesses. So it is being categorized under the mortgage loan piece, and the three loans which we mentioned, gold loan, personal loan, auto loan, are being categorized under consumption and other loan, if you refer over slide 5 of the investor presentation.
Okay. And what do you think, when do you think, your gross NPAs should be under 2.5 and the net NPA should be under 1? Like by what timeline do you think that would be, achievable?
Rudras, on the GNPA, we are already 2.5658. So we are almost 2.5 now. So it is just, if I talk about it, it's a slightly basic points difference, 6 basic points. We are talking about 2.5, we are typically 2.58. So we are already we are almost 2.5 levels. So we are working hard to contain it below 2.5 level rather. So that is what we are. And from the net NPA level, keeping in view the macro environment factor, there are a lot of macro environment factor in play for the asset quality, but we are able to come out very, very strongly in all the black swans historically. So which making us a better confidence that we intend to bring down the net NPAs as we move forward in the current fiscal as well. We're intending to reduce both GNPA and NNPA in current fiscal.
All right. And one last question. Are you guys focusing on gold loans, and why not?
You ask home loans now?
Gold, G-O-L-D, gold loan.
No, we are not focusing on gold loan. We being by our DNA, we are a production lender for a middle income group. Gold loan is a specialized play with a specialized set of customer. Our expertise is a middle income group for a production-led business. So we are less in a consumption-led business. We do gold loan to the client who is availing either of our main products, and he want a second or third product as a gold loan. Gold loan as a product is available, but it is not being sold as a first product.
So is this a value-added product, but like no mainstream goal to focus on gold loans, right?
That's right, Rudras.
All right. Thank you so much. I wish you guys the very best. Thank you so much.
Thank you, Rudras.
Thank you. This would be the last question for the day. I would now like to hand the conference over to management for closing comments.
Thank you everyone for joining the call today and for your questions and all the support through the years. In case you have any further questions, kindly reach out to the IR team and we'll be more than happy to respond. Thank you once again. Have a good day.
On behalf of Capital Small Finance Bank Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.